Well, good evening, everyone. Great to see so many of you joining promptly. Welcome to June's Investor Academy session on all things due diligence and valuation. As ever, if you've got any questions for our fabulous panel this evening, please put them in chat rather than Q&A. We'll be keeping an eye on those all evening. So before we move on to our fabulous panel session, just a few words about who we are. For those of you that don't know me, I am Simon Hopkins. I'm co-founder of Angel Academy. I'm just one part of a small but fantastic team. Many of you, if not all of you, know my co-founder, Sarah, who sadly couldn't be here this evening. She's otherwise occupied. So you got me instead for a rare outing in public. And also on the line is Michelle, our network manager, and Yi Mun is our MD, who I don't think is with us this evening, but many of you know her very well. But we're not just a small team. We are supported by some amazing long-standing sponsors, Kingsley & Appley, Hayes McIntyre, and DC Advisory. So before we get to the main event, just a few words about what we do as well as who we are for those of you that are new to us. So Angel Academy exists to close the gender gap in startup investment, both the lack of investment going to female founders and the low number of women angel investing. We've been doing it since 2014. So Sarah says we are very much the first kids on the block. We send thousands of pitch decks in that time. And we've invested, just recently we closed our an investment in our 51st company. And we supported many of these businesses through multiple rounds. So we've pretty much got more experience than anyone else in the UK in terms of female founder investment. So the question is, do we still need to talk about gender? Well, I think even those of you that haven't seen Sarah's presentations previously will know that the answer to that is a resounding, I'm afraid so. Just one statistic that last year, just 2% of all VC funding in Europe went to female founding teams. Angel investment in general and overall declined by about 40% last year. And as female founded businesses tend to be earlier stage, they were and are more dependent on angel funding like ours, they were especially hit hard. So we set up Angel Academy to deal with that. We are now in our 11th year, and we're very much about actions, not words. As I've said, our angels have invested in 51 companies, and we've helped mobilize over 150 million in co-investment. The companies we've invested in employ well over 1,000 people in high quality jobs. They generate many millions in revenues, and many have got a social purpose at the heart of their mission around possibly diversity, better healthcare, sustainability, improved education, and so on. We're proud to be one of Bohurst's most active angel networks in the UK, and indeed the only diversity focused network on their list. And we're delighted to be partners with Alumni Ventures and Innovate UK, who invest or deploy funds alongside ours. So just a few brief statistics. I won't wander through all of these with you because you're all perfectly able to read them, but we are proud that we have over 1,000 people in our network, and in our investor group, we are 70% women. Sarah's running gag for many years has been that her diversity target is 30% male, which she seems to be hitting. We have seen literally thousands of businesses in the last 10 years, and in any one year see over 100 companies that come our way. So that's, I think, probably enough about us. I am delighted now to welcome to the stage, the virtual stage, Ros, who's just going to say a little bit about our process and how that relates to the due diligence process. So, Ros.
Great, thank you very much, Simon. So hello, everybody. My name's Ros Singleton. I've been investing with Angel Academy for I think about 8 years now, which is quite something. And in that time, I've invested in a number of businesses. Over the years, we have collaboratively developed a process that we follow. It's useful to have it written down or bit at a fairly high level because it's a good way of explaining to both members of deal teams and the founders of the business that we're looking at how the process works. You may know that we normally have leads for any investment. So once an investment has been pitched to us at one of our pitch events, which are mainly online nowadays, there's normally one or two leads who are leading effectively the deal and the deal team. And those are normally the people that interact with the founder or the entrepreneurs directly to save them having to answer the same question from multiple numbers of people. So we try and be very respectful of their time. As obviously, as we all know, fundraising is very time consuming and difficult enough as it is. So the deal team then is sort of structured and got together quickly. And we ask that the entrepreneur, the company involved, put together a data room. So when we've had a pitch, Simon or Sarah or one of the other Angel Academy team members will send out an email to the founder explaining what we'll be looking for next. And that'll include a data room populated with a number of things like financials, for example, team structures, any deals or contracts that might be appropriate to put there, and so on. On the Angel Academy side, very importantly, we are assigning DD roles. So for any angels who have suggested they have an interest in this particular deal, quite often we'll assign people either according to their strengths or interests, or sometimes just because there's a bit of a vacancy in a particular area, if you like. So, for example, I often get tech because my background's quite technical. We have, luckily, a lot of angels with financial expertise, and they might often look at, for example, the accounts, forecasts, and so on. We look at teams and all sorts of other areas. That process then involves calls normally with the business that we're looking at and the teams there. So, for example, you might speak to their marketing team about their plans for marketing or sales moving forwards, how they're going to spend their money, and so on. We might take up references or speak to customers from time to time, or other investors who've invested with them previously, board members, and so on, to understand more about the business and the people there. The key part, though, is that we, as a group, all participate and follow the many hands make light work sort of scheme. This doesn't mean that anybody else is responsible for your own due diligence. You're always responsible for your own due diligence, and you invest at your own risk, of course. But it does mean that you get a number of perspectives. And personally, I find that really useful. There are many people with different experiences and different ways of thinking about things, and we really take advantage of that as far as we can. Once that's done, we move on to the structure of the deal. So we'll have been reviewing the legal documents in parallel, hopefully. However, it's really important that very early on, normally within the first couple of weeks, we as angels give a soft commitment to the business that we're looking at investing in. This is really important because obviously if we don't have enough soft commitments, for example, if we end up with, I don't know, let's say 20 or 30,000 pounds worth of potential investment, then, you know, as an entrepreneur, you'd have to ask, should you be focusing on this or should you be focusing on something else? From our perspective as well, it's important to be able to gauge the level of interest and make sure that we have a good understanding of how we set expectations with the founders as we move through. So going through, we'll review the legal documents, and then as we go through all those processes, the angels obviously are making up their minds. Some people may change their minds about investing and drop out. New people may be added who weren't perhaps at the pitch originally or have seen a recording or are interested for another reason. And so we co-create a deal memo, which is basically a document that summarizes everything we've learned. Depending on how you choose to do this, you often might have separate addenda with reports on marketing, competitors, you know, what you really think about the forecast and these sorts of things. And this is normally private to Angel Academy, though sometimes the deal leads do use it to give feedback to the company that we're working with, and to try and help and support them in improving their materials and the way they perhaps do some things, particularly as some of our entrepreneurs are quite early in their careers. And then as we move through, you give your final commitment financially, and then there's a big morass of signing documents and moving money. The whole process takes about anywhere between 6 and 12 weeks. Normally, everybody always wants 6. It's often more like 12. But we do try as hard as possible to get it over the line in a reasonable time frame, again, because really we want the entrepreneurs investing their time in their business, not in their investors entirely. And as we know, fundraising is something that comes around all too often. And obviously the very important part is you need to have funds available to transfer. So we do try and make sure people have those things and have done any KYC in advance that they might need to do. Next slide, please. So the areas that this is not an exhaustive list, by the way, these are the areas we largely look at for due diligence. Obviously, you can see those for yourself. We may add or take away, and we try and cover all these areas in the deal memo. Sometimes we can provide examples and those sorts of things. The key thing I would say, though, is there's nothing here that's particularly rocket science. It's all quite common sense. It's all the sorts of things that many of you will have come across before day to day. And it's really useful to have a single document as well as we come to perhaps follow-on investments and those sorts of things as the business develops. Again, being able to look back and say, did you meet your business plan? What was the original investment thesis is really, really helpful. So without further ado, then, instead of just listening to me talk, I thought I would introduce my other two panel members. So Susan and Rowena, who have both been with Angel Academy a while. Do you want to introduce yourselves briefly? Susan, would you like to go first?
Yes, thanks. So I'm a former fund manager and analyst, and I was also involved in a .com startup. So I've been there as a sort of founder as well. And I've been angel investing for about 6 or 7 years now. I've invested in 14 companies, of which I believe 5 have been through Angel Academy.
That's quite a good hit rate. Rowena.
Yes, so like Ros, my executive career was in information technology, writing software, leading services businesses. I ended up as part of a startup in my late 20s, so I kind of had the founder experience then, went through the dot-com boom, started my angel investing in 2006, so 18 years ago now. I've been involved with Angel Academy since the quite early days. And as some of you know, my most recent founder experience was as one of the founders of Women on Boards in the UK. So got a combination as well of founding and investing.
Okay, great. So what I've done is we've got some sort of questions to get the ball rolling. We're going to talk about due diligence a little first, and then move on perhaps to talk about valuations, and then I'll throw it open to the floor, so to speak. So if you could post your questions into the chat, as Simon said, that'd be great, and then he'll pass those on to us as we move through. So I'm going to start with the most obvious one, I suppose. So Susan, what are the benefits for you of doing due diligence?
Right. Well, obviously, the general benefits of due diligence is knowing what you're investing in and who are you investing in. So it's extremely important process. And I think it's quite unique in the angel space because the companies are so small and still at a very, very early stage, usually pre-revenue or just beginning to have any revenues. So really, it's important to meet the people and build confidence and trust in the people. And I would just also add that the process at Angel Academy, I find, is an extremely efficient process. So I have been involved in other angel networks that bring a lot of different sorts of expertise, often in sectors, but they tend to let each person go off and do their own due diligence, which I just think is incredibly inefficient, especially for the founders who, so just these very simple steps that Ros laid out in terms of literally making a team, making a data room, recording calls so that if you're not available, you could watch it later, constructing a deal memo. These all seem incredibly basic, but a lot of networks don't do it. So I just want to say that from a process point of view, that's also very important.
Great, thank you. I mean, Rowena, the first time you did due diligence, what was that like?
Well, I should probably contrast the first time I did due diligence on my own, when I was making kind of friends and family. And that really does highlight the value of doing it as a team, because you're trying to get behind the initial presentation from the founder and really under the skin of the business to work out whether it makes sense, and to what extent the founders understand how they're going to transform their ideas and ambitions into something. And we all tend to focus in on the areas we know. So when you're doing it on your own, your due diligence tends to be rather narrow, because you just don't know enough about, I mean, in my case, intellectual property and these type of things. I didn't know enough about it to ask, the right questions and see some of the things that can trip businesses up. So yes, the collaboration of the Angel Academy process stands in quite strong contrast to doing it much more individually.
Yeah, I have to say one of the things I've really enjoyed as well is like it's evolved as we go through. We learn every time, and and somebody will add something somewhere, and will add something to the process or the deal memo, and you think, oh, yeah, that's a really good idea. I wish I thought of that, which is quite helpful. So when you do due diligence, I mean, are there any areas you think are absolutely critical that you can't avoid? Susan, do you want to go first?
Well, I think all the areas that have been laid out in the memo are, do need to be covered in some way, and you have to have an understanding about those areas. But for me, it does come down to faith in the people that you're investing in, because the way the business will actually develop is never the way anybody has envisioned it to develop, because stuff happens. That's the polite way of saying it. And so you're really trying through this whole process, as you interrogate the different topics, whether it's the product, the market, the financials, the way the founders are thinking about it, how they've come to those decisions, and whether, if you challenge them constructively, how they react. Do they react in a curious way, and are they interested to learn, or are they defensive? And I think that therefore it's really crucial. I think we all agree building a very open relationship and trusting relationship is the core of the process.
And Rowena, I mean, are there any particular tips or tricks you have for building trust with founders through the due diligence process?
Well, I would say, one of the ways I think about it is, what is the why behind the business? Because I am very now kind of impact purpose focused. So if there is a really nice story behind why they are doing what they're doing, for me, that tends to be a really strong underpinning for success. When we founded Women on Boards, one of the things I did on the website was I put up a page that was basically, our raison d'etre, why WOB exists, which I think some people thought was a little bit odd, but I guess probably more so if you're in a B2C business, but that ability for people to feel like they understand why you have created the product or service you have created. Is there something about that strengthens your link with your customers? So for me, that is, one of the things I'm interested in.
And is there anything you've come across that has been a turn off for you, where you just go, that's just not acceptable. I will never invest in a business with that particular answer, or whatever it is again? Well,
I think that comes down to the integrity of the founders and how they behave. We'll probably keep coming back to the importance of the team. But for me, you know that whatever their plans are, things are going to change. and you're looking for that flexibility. But if you get a sense in the due diligence process that people are not being completely honest, if they're holding stuff back, that is for me kind of almost the biggest red flag, because if in the early stages people are treating their stakeholders with less than respect, then I just can't see people building a business on that basis.
Yeah, when it gets tough, it'll just get worse, I suppose.
Yes, if you're treating your employees badly, or your suppliers badly, your investors badly, you can only get away with that for so long.
That's very true. And so, I mean, Susan, when you struggle with an area or you don't know a particular area well of due diligence, how do you deal with working through that, whether it's in a group like Angel Academy or otherwise?
So I think there's really, a few ways to go about that. And I think we all encounter that in our professional career more broadly. So first of all, you could just look stuff up and try to educate yourself through public sources. And there are, a lot of public sources now that you can just learn about a business, something you don't know about, look up the competitors, anything that's been mentioned in the documents, just give it a, look into it yourself a little bit and kick those tires. Secondly, of course, through Angel Academy, we really do have a very wide range of people with experience, I think, as you both have alluded to. And for example, the intellectual property area is a very good example. I think that's something that's come up more and more in recent years, and we have some fantastic angels on board. So, we ask around the group and see who else might know and who else might be able to better lead those questions. And then finally, I'd say, and very importantly, ask the founders to explain it. Part of the job of being a founder is to be able to explain something complex and perhaps technical and a market that we may not be familiar with in a simple way. And they should be able to explain it clearly and answer questions clearly. And that also is extremely important in giving us confidence that they understand their business and their place in their own marketplace.
Yeah, that's incredibly vital. And I mean, I suppose to both of you, but we see and sort of specialize in B2B tech businesses, I guess. And I think, it gets a little bit more tricky to find data and understand traction and competitors and those sorts of things. Are there any particular ideas either of you have about how you manage that B2B focus rather than the B2C business, where it's less easy to put yourself in the shoes of a customer?
I guess my first stop is usually my network. You get to this stage and age, and when you've worked in as many different companies and countries as I have, it's okay, who do I know who's going to have some sort of insight into this? So that's normally where I go first. Oh, you're
mute.
Sorry. I would just add to that that it's also, you can also ask the founders whether you can speak to some customers. So that is another way that sometimes we educate ourselves. But I think that I primarily invest in B2B and sort of the businesses that are less sexy, and there's a lot of plumbing in there. But there are certain business fundamentals that are common across all businesses in terms of the way they work. So you just try to conceptualize it in the way that you can understand from a common sense point of view, and try to figure out, what are the key areas that I need to, kick a bit harder to try to understand.
Yeah, that makes sense.
Yeah.
Sorry.
Yeah, there's one thing that came to mind then is the importance of sales capability. It's very easy to get seduced in your early days as a founder by a few early adopters. And I think the difficulty of selling, the challenges of sales is hugely underestimated. So in terms of things to be probing, particularly B2B, it is that understanding of how long it may take to close a sale, and if the founders aren't naturally salespeople, how they're going to address that. And I mean, even if you do an MBA in this country, you're very rarely taught about sales. It's one of those skills that is so important when you're setting a business up. And nobody really knows how hard it is and how long it takes unless they've done it a few times.
And I just want to echo and expand on that. I think that Rowena is correct, that that's one of the biggest areas that I think we end up probing, and that sometimes we need to help educate the founders a bit to think more closely about it and then to come back to us. It's really the route to market. What is your way into this market? And especially I think in B2B, they often underestimate the problems of selling to large organizations. Will they need certifications of some sort, whether it be cyber or some kind of ISO? And so there's a little bit of a chicken and egg problem. So they have to really think clearly about how they can approach the market, and is there a staged way that they can do that so that they can start to build some revenues, so that as they build out those processes and certifications that they need in order to sell to the larger clients.
Yeah, I think that sort of calls to mind as well. The fact it is to a degree iterative, if you like, in the sense that due diligence sometimes can cause some changes to the business or the forecast as we, work through with the founders and hopefully provide them useful feedback. At least I always hope it's useful. So moving on a little bit to structures and then through to valuations, and obviously we are often not the lead investor in a deal as Angel Academy. Hopefully there is often an investor with much deeper pockets. How do we work with those, and how do we think particularly about actually what the red lines are for us in terms of the deal and those sorts of things? Rowena, do you want to kick off?
Well, I guess, I mean, for some people, even the concept of a lead investor may not be obvious. So, I mean, Ros, you're probably more qualified than I am to talk about the role that a lead investor does play, but it's certainly an area that I feel, I've been learning about. So I don't know whether it's worth us explaining that, but I'm probably not the best person to do so.
I'm wondering if Susan's probably better than me to explain, given her background.
Yeah, so I think that, I mean, angel investing is a little bit different, because if they're the earliest stage companies, SEIS, they may have only been funded by friends and family and their own savings. So in that case, we are more likely to be sort of the equivalent of a lead investor for them. But as soon as you get to the next stage, usually they will have looked for a more traditional lead investor. Sometimes they've come through incubators who have some kind of a position. That's often quite common for us to see. But I think that, lead investors, there are a wide range, Simon can talk about them as well, that are now involved in the market. Some of them even have EIS funds in which they're deploying capital. And they come in all shapes and flavors. And if there is a lead investor involved, they will usually try to dictate the terms of the term sheet, and we may only have limited ability to impact those terms. And those terms are not only the valuation, but may be certain rights, preemption rights, etc. And so as soon as there is another lead investor involved in a deal that we are considering, it's very important that we know who they are, and we do some due diligence on them, which is something I think people might not realize that we do. And the reason is that they are likely to perhaps have a seat on the board. They may have quite a large stake in the company, and we are going to usually be having what's called tag along, drag along position, so that the founders plus the lead investor will be empowered to take key decisions, and we kind of have to just put up or shut up. And so since we're going to be in that position, we do want to know whether they are a good investor that we want to work with. Very often we do get to speak to them, which is helpful. And if they've got a sector expertise, that's fantastic. We can share. We've done that a number of times where we sort of share our thoughts and points of view. Sometimes we work together to give some thoughts to the founders. And I would say that we do also play an interesting role alongside lead investors, because they end up behaving in the end more like venture capital. And sometimes their relationship with the founders can become a bit adversarial. And I know that from my own experience as a founder over time, because of the control that they may exercise. Whereas because by the time we've gotten anywhere in the process, we're not at all a controlling shareholder. We really are not in a position to influence. We can influence outcomes, but we can't control them. And so sometimes we have we can have a very closer relationship with the founders, and that's why building up trust is so important. I think we find that they come back to us and they speak to us perhaps a bit more frankly, because they're a little bit less threatened by us. And I think that gives us a privileged position, but it also makes it really fun. I mean, I think the one aspect we haven't yet mentioned is how much fun I think we all find this process. We have met some wonderful founders with wonderful businesses, and it's that process of helping them to develop the business and address any problems that they've encountered, help them figure out how to pivot, as they all have to do. And anyway, so that is a bit of a longer question, longer answer to that question. But I think that the question of who you're investing with is an important one. And we have had very rarely cases where the investors are not transparent to us. And in the future, if they're not transparent, there could be problems when they go to raise later venture capital financing, because if somebody is offshore and it's not transparent, that could be an issue. So it is important that we do some due diligence and build relationships, if possible, with the other co-investors.
Yeah, absolutely. Yeah, I think it's basically you're going to be in a partnership with those people for some years, and obviously any changes to share structures can affect the SEIS or EIS status as well. So we particularly keep an eye on that too. So having spoken about valuation briefly on that, then let's just chat about valuation. So Rowena, obviously, as we were just saying, if there's a big lead investor, then to a degree they set the terms and the valuation. Obviously, we often fight tooth and nail for certain things like information rights. But when you hear a valuation or you're asked about a valuation, how do you go about assessing that and understanding it?
So I think this is something that I've really, learned a lot about along the way. I do have a tendency to get really excited about a good idea and an exciting founder. And you can get yourself to a point where you really want to put your money in. And the fact that actually, however successful the business goes out to be, if you come in at the wrong price, you might not make any money out of it. It is something that you have to learn, and it is something I have to remind myself quite regularly. So as I'm sure we'll discuss, it is more of an art and a science, and it is something you get a better feel for as you see more deals and more valuations. But for me, I think the bottom line is, however excited you get about it, if you can't influence that valuation, and if it does really feel too high, then it's probably a good thing to step away or try and educate the founder that actually this doesn't make sense. And of course it's difficult for them to know what price to go out at. Oh, you're on.
Yep, sorry. Everybody has to do it at least once in a call, right? So, Susan, do you have anything you'd add to that, or any particular issues you'd look for there? Have you ever backed away from a deal, for example, because you think the valuation was a little bit bananas?
Oh yeah, absolutely. So I think that you do get a feel by doing the deals. I think most of these very early stage companies we look at, I think the lowest your valuation is sort of £1.5 million pre-money and maybe up to about 5 million. When they get above 5 million and they're pre-revenue, you know, you'd have to be pretty convinced. And one way to help think, I find, to help think about it is a bit of common sense or rule of thumb, which is that, you know, as Rowena was saying, the price you go in becomes very important. And if the company is valued at, let's say, £2 million pre-money, and you put in £10,000, you're getting 0.5% of the company. That's, you know, reasonably substantial, actually. But if the valuation is £4 million, you're getting only, you know, a 0.25%. So that doesn't mean, and I do invest at that level, but then you might, you know, I tend to think my own rule of thumb is that I like to have 0.5% or 1% of a company at this very, very early stage, because then, you know, we're going to get diluted later in a big way if things go well. And that way, if it is very successful, and I've had a few companies that have been very successful, that small investment can actually be very valuable. So it's good to turn the investment around and think about how much of the company are you getting at the different prices.
Great. No, that's yeah, that's really helpful. So I'm going to move on to questions. Apparently, I've got quite a few questions coming in. Let me just have a look. So first one from Catherine: what key signs do you look for that suggest founders are more idealistic than practical? Rowena, do you want to try that one first?
Well, I guess that comes out as you start going through the due diligence questions, and I guess from an idealistic founder, and this is kind of my interpretation of what you mean like that, they will probably have missed quite a lot of practical things that need to be done to turn their idea into a success, whether it, you know, if it's in the health tech space and they've never heard of DTAC, which is one of these you know, regulations around medical devices, or they don't realize that they're going to need some sort of cybersecurity assessment. It's when you find gaps, just complete gaps in the answers to questions to things that feel like quite common sense requirements.
Susan, anything to add?
No, I think the only other thing is often to bring it down to cash flow as well. So everything they're going to do is going to cost something, and hopefully there'll be some revenues at some point. But especially on the cost side, I think that, you know, that the financial model can be a good way to help look at how are they thinking of spending the money, how much is insourced, how much is outsourced. And by just, you know, probing that a little bit, you begin to understand, do they understand something about particularly the cost of delivering their business?
Yeah, no, that's right. The importance of cash, it is worth remembering. At London Business School, I did a course called Managing a Growing Business, and this was where I first heard the wonderful phrase that revenue is vanity, profit is sanity, and cash is reality. And some people just have no idea that you can actually be profitable and go out of business because you've run out of cash.
Yeah, I've had to explain that one a few times myself. I mean, the other fantasy thing I come across is people who've got a plan for all their valuations, but don't have a plan for what they'll change in the business to move between, you know, a 1 million, 10 million, £100 million valuation. They've just got, we'll do a raise at this and a raise at that and a raise, and no real idea of what they're going to achieve in between, which I always find entertaining, shall we say. Though, you know, I suppose it's what you read in the news, right? So next question from Carolyn. After a company has been successfully sold, how soon do shareholders see money? And does the acquiring party always buy out all shareholders? So Susan, as you mentioned this sort of thing before, I thought I'll pass it on to you.
Yeah, so there's many different types of exits. There's full exits. Well, so if it's, first of all, the company could be unsuccessful and need to be wound down. I fortunately haven't encountered that. So maybe if one of you has, you can discuss that. I know that there are some EIS tax breaks that come in that case. But if they're sold, there can be partial sales and full sales. In my experience, the the least successful companies are more likely to have a full sale quickly. So if it doesn't really work, but they've built something useful, then I have a few cases where they've just sold themselves for cash, and it's all to somebody who wanted that sort of little tool in business that they built. We've made a little bit of money, we get the cash back, and everybody's reasonably happy, and that can happen extremely quickly. On the other hand, the more successful companies often they keep doing further fundraisers, and if you're lucky, you get partial exits during those fundraisers. So you end up sometimes, and either you just keep holding on the original shares, but you get some cash out, which is just fantastic, or you sometimes I've sold and I have shares in the acquiring entity, and luckily I've gotten some cash out, because when you get shares in these acquiring entities, they're usually private, they're often American, and they're usually overvalued, and you end up sitting for years on the shares of some entity that you have no control over, but hopefully someday we'll get some cash out of. So it can be the time period can be very varied.
Right,
Yeah, just to add on the other end of the scale, when if a company goes into liquidation, in some ways that can be a better outcome from an investor perspective, because once that has happened, you get to take your the loss and offset it against other gains. Almost the worst case is companies that are never particularly successful. They become just a source of income for the founders. So the chance of making a big exit goes away. But if the founders just keep running them for personal income, you can't take the loss against future gains, and you end up holding shares in a company that's never going to be worth anything. So yes.
Yeah, both good answers. So next one for somebody anonymous. Beyond the general due diligence framework, can you elaborate on the actual due diligence activities and tools, and what a good start point for a particular area, as an example, can be? Either of you?
I mean, there's a lot of just diving into documents, and again, this is the advantage of doing it with other people. So there will be some people in the due diligence team who love getting into the contract or into the IP report, and there are others who love getting into the spreadsheets. But there's real grunt work we do to check out the quality of what we've been given. And then we've talked about phone calls, whether it be with the technical team, whether it be customers. So all of us will typically put in quite a few hours over the course of the due diligence process, looking at what we've been given, asking for more information, just doing that work.
And I just thought I'd just add that, so as Simon and Ros mentioned at the beginning, Angel Academy has a sort of standard list. They ask the founders to set up a deal room. They give the founders a list of what we would expect to be there. And so that is really the starting point. So that's just a important point. Secondly, I think it's also important to mention that for people on this call, that there are different levels of doing due diligence within any particular transaction. So, hopefully someone will sign up to be the lead. Often we have co-leads. Then there'll be a team of people that have agreed to take charge of a particular area of investigation. And then there may be others who are interested, but just either don't have the time or the expertise to do so. And so if you're learning, you can agree to join a team and you can just listen and watch. That's very useful. Or if you are experienced, but you just don't have time, and a lot of us are in that position sometimes, we say we're interested, we keep involved, if we can attend a meeting, we'll listen. Sometimes we'll watch it as a recording. We'll read the documents when we have time, and we can still participate and ask the odd question or give a point of view. But there are different ways to do due diligence. It is important, though, that you don't always intend to be the rear seat passenger, because we are a sort of a team of people and we're all busy. And it is nice that once you feel comfortable doing so, that you try to participate, and also you get to learn, and I think it's very enjoyable to lead a particular activity.
Yeah, I'd say it's like anything as well, right? You need to do it to, at least for me, you need to do it to really learn how to do it. And a lot of it is just, I would suggest, common sense. I mean, one of the innovations that we have, which is not really innovation, is a Q&A spreadsheet, which I find particularly useful, that's shared with the business. So in whatever shared area you're using for your data and whatever, and actually that's great, because it means you can just, like, if I'm reading a document and I know it's whatever at night and I don't have time necessarily to attend all the calls, I can bang in a load of questions that have come up from looking at other things or listening to calls. And again, people can refer back to that, and I can refer to it and go, somebody already asked this or something very similar. Just things like that make a huge amount of difference to the amount of knowledge we as a group have, and also to, again, respecting the founder's time. But a good start for a particular area is always going to be, well, what do I think about this? Where would I logically go? Quite often you start from the pitch deck, and then you might speak to the team, and depending on what the area is, then you sort of follow your nose from there. It's rare that we have investors who aren't people who've got experience of one thing or another. And really, I've not come across anybody who isn't capable to help out significantly with DD. I've met people who aren't confident to do it, but that's a very, very different thing from not being capable. Sorry, next question. Any advice on getting information or updates? Founders promise them, but after a while they seem to stop or become very infrequent. That one from Chrysula. I think I may know some of the businesses Chrysula is talking about. Rowena, would you like to take that?
Yes. I think there is something about trying to maintain a dialogue with founders, giving them encouragement along the way, keeping involved, but actually, do you have any leverage to get information if for whatever reason they don't have time? I mean, clearly there is what they sign up to in the term sheet, and normally information rights are in there. But from personally, I just try and keep a relationship going at some level by responding to updates, sending information if I see it, anything that I think might be relevant to the organization. But you're really you're relying on people's goodwill, and the fact that you're trying to maintain a relationship that becomes more and more distant the longer it is from the investment.
Great, thank you. Anything to add to that, Susan?
Just to say that I actually think that when companies go quiet, that's often the most important time to try to reach out to them. Usually when they've gone quiet, sometimes it's just they're always busy and they really are just finalizing something big, and they'll just tell you if you mention it, and they'll say, we'll be getting back to you. But sometimes it's an indication that, maybe it's not all going to plan. And so that's why this building a trust and relationship is important early. And of course, not all the angels will have built a relationship with every founder, but probably within every deal team, there are one or two of the angels that have built some sort of relationship and are sharing information and chatting. And sometimes I know I've just offered to meet for a coffee or a virtual coffee, and then when it's gone really quiet, and then they sort of everything pours out and you realize that they really do need some advice. And I've really enjoyed doing that, and hopefully that's been helpful for both sides.
Yeah, it's that recognizing the human nature of it's much easier to share good news than it is bad news. And yeah, as Susan says, it is typically when things are going badly that the information pipeline shuts down.
Great, thank you. So I'm aware we've got quite a few questions and not enough time. So I'm just going to pick on a couple of these. So do Angel Academy ever collaborate with other investors or investor groups on DD? Susan?
I don't know. We do our own DD as a group, but I do think, I mean, Ros, you may have experience, or Rowena, where we sort of have joint calls sometimes, with the others alongside. And if a particular issue has arisen, sometimes it's also with existing investors, and then we can often collaborate to encourage the founders to, give more information on the subject.
Yes, I mean, I did recently speak to another angel group that was looking at an investment in a company where I'd been one of the deal leads. And they were just interested in our conclusions and how we'd got there. So Sarah connected me up with them, and I just, shared some of the insights and some of our conclusions. So yes, I think the answer is we do on occasions.
I think when we do co-investment as well with some of the funds that co-invest with us, we tend to share DD with them to an extent. Obviously, it's not quite the same as, being on the calls and participating, but, we do share some materials as well from time to time, I think. So, this is doozy. How do you look for the right balance of coachability and tenacity / self-belief / bloody-mindedness in a founder? I'm sure we've got a special magnifying glass or litmus test for that. Go either one.
I think for me, the openness of the founder gives you insights into how you're going to be able to interact with them going forward. There is no right answer to this because every business, every market will need different combinations. And clearly one has to be looking for ambition. One needs to look for an understanding that there are going to be boulders in the way and the ability to be flexible. But yes, there is no one way to do that.
And just to say that I think one reason we all invest in so few companies compared to how many try to set up is that, it is actually quite difficult, or it's a rare characteristic to find people that are both so enthusiastic, entrepreneurial, ambitious, and yet are prepared to listen. It's not always a obvious combination. And so, I think we immediately look for and we see in the pitches, and that comes across very quickly, the enthusiasm and the commitment and what they've been doing, and how have they managed to get to the point they are now, because usually they have to give up income. It's been quite difficult. So I think you can gauge that quite easily. And really, it's the harder part is the sort of human nature and the willingness to be a little bit not quite a little bit have some empathy and listening characteristics, and you just have to build by talking to them over time.
And I think I can almost link it back to the why behind the business, because if you can see this is something that someone is really passionate about, for me, that passion will underpin getting through the tough times. And so, yeah, I think there probably is a thread for me around, are they really in this because there's a problem they want to solve, and they'll go that extra mile?
So just to sort of expand on that a little bit, there's a subsequent question from Simon Goldsmith about, looking for the characteristics to distinguish between an enthusiastic lifestyle entrepreneur and someone who builds to a business that has acceptable returns for an angel investor, because I can see that there's quite a lot of nuance in there. Do you have any thoughts on that?
I mean, I think most founders wouldn't necessarily think about the difference initially, but for me, there is something in there about the ambition that is demonstrated at the early stage.
I guess I would also say that usually the founder or one of the founders has come from larger organizations, because in the end they have to learn to sell to large organizations their product. And they also have to understand what it is like to scale up and be a large organization. So, it is useful if they have had, at least at some point in their career, that experience, and they can express to you, I think, as I think you were saying earlier, something about how to get from the 10,000 pounds of revenue to 100 million pounds of revenue that's in their Excel spreadsheet. If you can talk to them about that and have them express it in a logical way, even if that isn't exactly what is going to happen, you can begin to test that level of ambition. And of course, you have to look at the scalability of the business model, right? That's also an incredibly important factor.
And another question: Are there any absolute red flags that either of you have? I mean, I know I have one or two things that I'm a bit weird about, which are not necessarily logical. But how about you two?
For me, it's someone I lose trust in during the process.
For me, it's arrogance.
Okay, cool. No, those are very sensible choices, much less than mine. So perhaps then we'll just move on to final thoughts and wrap up, or I'll hand back to Simon to wrap up. So, Simon, I don't know if could you pop the last slide up for me, please, as my glamorous assistant? Thank you. So just to sum up some thoughts, just to close out a little bit. So I think there are some really important things, and one of our Angel Academy members, Kanika, I think, put this list together originally, and it's very, very true. But one of the key things, and we perhaps haven't covered this today, is actually about making sure that our due diligence matches the size and scale of the business. It's no use asking somebody for a 10-year detailed financial forecast if they've been, in business for 2 years and are still exploring product market fit. It's just a make work item, for example. As both Susan and Rowena have said, actually, it's fun, right? We need to keep it fun, use the network, help the founders and help them prepare for other due diligence, future fundraisers. Almost no matter what happens, we often end up with a very good relationship with the founders anyway, who may come back to us for later raises if now isn't the right time, for example. But if we can help them be better at raising, then that doesn't hurt anyone in the long run. It's really important to realize that due diligence, as with valuations, is an art as much as a science. We often add things, take them away from the list that you saw earlier, and it's constantly evolving. We always enjoy our members contributing new things that we think are useful, or new tools that might be useful. Going in with an open mind is really important. Confirmation bias is, a thing. And at the end of the day, angel investing is a relatively risky investing activity. It's not like investing in a tracker. So you really do have to go in with an open mind, be aware of your confirmation bias, and understand how you're thinking about the investment, and try and understand other people's perspectives as well. Yes, and it sounds very philosophical, but not what you look at is how you see. I think we do have to be careful as well to make sure that we look at things through several lenses, and then obviously stand back and make our own judgments. We obviously have a lot of material on investing and various elements of it, particularly on the tax breaks, which are quite interesting. As Rowena was saying, if a business goes into insolvency, then actually from a tax perspective, you can offset any remaining investment that you haven't already claimed. Which is better than a business that's in a stasis point, I think. So at least you can reinvest that money. So we have quite a lot of videos on those things on our YouTube channel, and I'll hand back to Simon to wrap up.
Thanks, Ros. Just before you go, Ros, you left us hanging with, well, maybe you didn't deliberately leave us hanging, but you said that there was a question about red flags, and you said, oh, I've got a couple, but then you asked others, and they gave great answers, but now I want to know about yours.
Yeah, I have a similar one, which is arrogance or not listening, or having other people that I'll completely listen to. And the other one is I don't like investing in family members. So, you know, but that's, like I say, personal and kind of weird and has no evidence base. It's just something that I find very difficult from personal experience.
Okay, it's good to know. I just needed to
Yeah.
know. I couldn't have closed down the session without asking that, I'm afraid. Well, look, Ros, thank you so much for sharing that so ably, and to Susan and Rowena for your great conversation, and indeed to all of you on the call for your fantastic questions. We had a whole bunch more we didn't get around to. Sorry about that. We are time constricted, but just before I let everyone go, driving my own deck now, having no glamorous assistant, unlike Ros, just run you through a few things. If there are any founders on the line and you would like to apply to pitch, please do so at the link there. I think Michelle is going to ping the links in chat as we go along. If you're interested in investing with us and you're not currently a member, again, please get in touch with Michelle. We run Investor Academy Investing 101 sessions, a half-day workshop 2 or 3 times a year. So please get in touch. We are also all over various social media channels, but please in particular subscribe to our monthly Substack, which has got lots of news about us, our members, our founders, and our general thoughts about what's going on out there in the world of investment and technology. And it's been mentioned several times, and indeed I popped in a link into chat. I don't know if some of you may have seen it, to one of our YouTube videos, which is the most recent Hayes McIntyre video about SEIS and EIS tax breaks. That is always a particularly popular one, but there's loads of stuff in our YouTube channel, so please check it out. But I think we are out of time. So once again, thank you to Ros, Susan and Rowena. Amazing job. And look forward to seeing many of you soon. Okay. Thanks, everyone. Bye now.